Hello again, everyone, and welcome to the webinar. I'm Nick Zulovich, part of the team at Cherokee Media Group, and pleased to welcome you into our session today. The next wave of auto risk. Is your recovery strategy ready? So again, thank you again for joining us here today. We're pleased to welcome in two of the experts from Allied Solutions, Ann Holtzman and Brooks Stewart, who have some great information and insights prepared to share during our session today. And just a quick couple of quick housekeeping items. We are recording today's session, so please keep watch of your inbox for a recording, a link to the recording, so you can share with others at your shop and review the great information. And also, if you have any questions, please drop them in the chat function here on the Zoom platform, and the team at Allied Solutions will reach out to you directly to address those questions that you might have. So again, welcome to our session today. The next wave of auto risk. Is your recovery strategy ready? So please welcome again Ann Holtzman and Brooks Stewart with Allied Solutions. Ann, Brooks, welcome. Thanks so much for being with us.
Thank you, Nick. It's a pleasure to be here.
Thanks for having us, Nick. Always a pleasure.
Well, Brooks, as we look at what's been happening over the last 12 to 24 months, we can definitely say that the environment has become very complex, and the word recovery is kind of on the tip of everyone's tongue. What we hope to share with you today is a little bit of what's changed, even since we were all together at Used Car Week just a few months ago, the affordability situation with vehicles, signals you can't ignore, how you can proactively identify those risks, and then what does it mean to choose the right partner and the right strategy for recovery optimization, and just ensuring that you know who's representing your brand. So thank you again for joining us today. So Brooks, as we look over what's happened in the last 24 months, we think about the complexity of what's happening out there. We're looking at situations where folks are in record levels returning their vehicles to lending institutions and financial institutions. What would you say, before we jump into data, that you're seeing as you're spending a significant amount of time out there with lenders, that they're most challenged with, and what they're experiencing that maybe they weren't even experiencing 24 months ago?
Yeah, thanks for the question, Ann. I think the one thing as we dive into this topic is forefront on everybody's mind is delinquencies, right? And delinquencies are continuing to be at all-time highs. This is driven by not only the affordability piece that you talked about. There's economic things that, as we know, are going on in the world that are driving up gas prices and different things like that. But really, the things that we're seeing outside of those economic pieces are just changes in lender behavior, right? And a lot of that is borrowers are having to make decisions on what they're going to pay and when they're going to pay them, whether that's insurance or making a payment. Are they going from two cars to one car as a family? And those are things that continue to see pressure throughout the industry. And then the last piece of that is the total losses. And with the increased price in vehicles over the last really 8 to 9 years, with the addition of the telematics and the things that are now in the vehicles to make them safer, smaller total loss percentages are going up because it's so expensive to repair those vehicles. So as you see those things start to change in the lending institutions, what you're also seeing is a greater negative equity because of the length of terms that we're getting into in these loans.
Yeah, as we look at it, so next year will be my 40th year in property casualty insurance. And what I can tell you is the last 5 years is the most volatile that I have seen the voluntary insurance market. So we think about a rise in auto insurance since 2020 of 55%. In some states, as much as 35% in a 24-month period. as you look and read about the insurance industry overall, especially the auto insurance industry, they're basically challenged with the repair of vehicles. Not only the repair costs of vehicles, which is substantially up, but also the amount of time it's taking to repair vehicles and the amount of time and effort that's having to be put into those repairs, which are leaving consumers without vehicles for longer periods of time, which then lead to negative reactions from the consumers to the insurance companies around the repair of vehicles. Just thinking about the cost of a new vehicle, what it costs to insure that vehicle, and then those increased payments. So as we think about that, Brooks, it becomes very fragile. The environment is very fragile, and there are things beyond payment that are really challenging borrowers today. How have things changed in the way in which borrowers are now looking to want to exit loans?
Yeah, so I think you're starting to see increase in repossessions. I think that's been going on for the last really 12 to 18 months. You do have a higher propensity for voluntary repossessions. So they're, volunteering surrender those assets back to the lending institution. Some of that, as we talked about it earlier, they're having to make trade-offs right in their lives. And a lot of this has to do with the affordability of the assets. Lending institutions and the industry's tried to make some changes with that by increasing the term. So it wasn't that long ago, you never heard of an auto loan over 60 months, right? Now you've got them as far as 82 months, and you've got people, playing around with 88 months. And so that is going to lead to more vehicles that are in a negative equity position, right? There's greater exposure. Another piece of this, there's greater exposure in the subprime auto market. We've had lots of players in that industry exit over the last 12 months. I think there's been 5 major players that have left, which is creating a strain on the industry as a whole for where those borrowers who used to be able to go find cars aren't able to have those sources anymore. And then the other thing that I think I talked just a little bit about a while ago, was just the rising of living cost, right? Mm-hmm. We haven't seen a drastic decrease in the housing prices. I know that there was a publication last quarter that Cox mentioned that savings rates were down at their lowest level since 2022. So all those things are leading to lenders and borrowers having to make decisions on what payment they're going to make throughout the month.
Next slide, Amanda. I know, Brooks, as we look at that, it's folks also getting kind of behind the recovery curve. And today, when we think about the demand for recovery optimization and recovery resources, and we think about the whole life cycle of recovery, it goes beyond repossession. So as you're looking to fill that void of larger deficiency balances, you're also needing to fill that and ensure that every aspect of recovery is optimized. It's actually an ecosystem versus a single action. Can you speak a little bit about what we're seeing, feeling, and what's critically important for financial institutions to focus on as they move forward in this ecosystem?
Yeah, over the last 6 months and me spending more time with some of our lenders and some of our product development things that I've been working on here at Allied, the thing that keeps coming up is, how do we look at our portfolio as a whole, not just looking at a total loss as an example, or a repossession or as an example, right? It's really looking at, as I think about the ecosystem, I think about the life of a loan, right? And are you tracking that loan, right? Or are you making sure that customer has insurance? And when they don't, are you taking actions to make sure that they are notified that they need to keep that on their policy, right? Or that policy on their lien. When you get into a total loss, right? Having the right information, having your liens on your borrower's information makes it easier to file those lender claims when you need to do this. And then when you get into the repossession space, we're starting to see lenders lend in different ways than they have in the past. Where you traditionally had your buckets of, you had your prime, your non-prime, your subprime. You now have lenders playing in all those spaces, right? And that are playing nationally where they've been regional players in the past. And when you go from a regional footprint to a national footprint, you need additional partners to be able to help you, because you can't just use your 4 repossession agents that you've always used. You need to have a national network that can give you the ability to do that. When you think about saving and recovering dollars in every piece of this workflow and this timeline of an asset, they don't always happen at the same time. But maximizing your total losses, maximizing your repo damage claims, and maximizing getting the cars picked up the fastest and getting them to the right facility to liquidate is really where we're starting to see lenders dive into each one of those buckets and ask for additional help where they haven't in the past.
Absolutely. If we kind of move on here, Amanda, one of the other things, Brooks, that we've talked about is this affordability situation. So as you're seeing too, consumers be protected, purchasing things like warranties and GAP and other additional financial protection products on a vehicle, you're also seeing some dealers and lending institutions not wanting to sell a vehicle with negative equity without a GAP policy. As we think through that and what's happening and what that does to trade-ins, how do those trade-ins and that repossession activity, how does all that come together to strain the system, not only for affordability, but also for resources?
Yeah, so that's a great question. One of the things that in the history of me doing this in the space for, you said 40 years, I've been around this now almost 30. I'm getting older every day, right? But we're seeing about 30% of the vehicles from the data that we're seeing that are traded in with negative equity, right? And that negative equity isn't, $1,500 to $2,000. It's somewhere $7,000 to $8,000. And part of that is what I've already talked about, is the extension of the loan time, right? And with higher APRs and the longer terms, it's going to take you longer to get yourself into a positive position with those assets. And so historically, anywhere from 28 to 36 months, people are coming in and out of their loans. A lot more of them are ending up in a negative equity position today. And so that, along with everything else going on with inflation, is really putting a damper on the car market in general.
Absolutely. One thing too, thinking about that total loss, we also are seeing, and we're hearing from lenders, is unprotected collision damage. So as insurance carriers are also strained with the number of total losses that they're dealing with and the number of repairable units that they're dealing with, it's very difficult to navigate not only making that collision payment to their borrower, their insured, but also putting that borrower through the situation of having the loss payee on the check. So we're seeing more of that, just an understanding that if they pay for that collision damage, the borrower doesn't get it repaired, and that lender has to be repossessed, there's an obligation of that insurance carrier to pay that claim again. And we're seeing that, reach into this efficiency play for claims as well, along with the total loss aspect, which is by the time I add rental, by the time I add additional repairs, by the time I adjust for that downtime, it's easier in some instances to do a total loss. And that too is affecting that negative equity. If we go on to the next slide, one thing, Brooks, as we think about that affordability factor and we think about, okay, we know, right, there are early indicators that something could go delinquent. Can you speak a little bit about how we might be able to proactively look at things like loan monitoring or other solutions as early warning signs? and how a lender might use certain data to proactively model out what may go delinquent.
Yeah, and I think one of the big things that we're seeing across the industry really over the last 4 years is the migration away from just a pure FICO score, right? Being the deciding factor on credit. Most lending institutions are moving to do credit cards. And when I mean a credit card, I don't mean an actual credit card, but a card that it uses anywhere from 20 to 30 data points, right? And it's making decisions based on historical transactions in those individual data points to better predict the payment activity of that customer, right? And so I know those of you that have been to out in the environment here in the last year and a half, you're seeing lots of AI companies, right? Talk about data scoring models and how to be more efficient in your data scoring model and looking at that data faster than you historically have with those key indicators of delinquency coming faster. The other things that you can do is when you talk about insurance monitoring, and as you talked about, we're seeing a higher propensity in the loans that we monitor, right, of uninsured assets. And so that's a direct correlation that if they're not paying and keeping up with their insurance, especially with the increase in insurance rates over the last 2 years and 3 years, they're having to make those hard decisions on what they're going to pay each month, right? And the average family is, one life event away from not being able to make their car payment. And so when that happens, it takes, a couple of months to get back on track. And in talking to some of the lenders out there, we're also seeing an increase in deferments and different things that lenders use to keep that customer on track. But it's really getting at a critical mass here as we move forward.
Absolutely. If we can move on, Amanda. So it doesn't really stop at delinquency. There's a behavior shift that occurs pre-delinquency. So think about loan monitoring, that proactive scoring, the use of AI, insurance tracking and loan monitoring, vehicle alerting services, address correct, things like that really allow you to know when something isn't right long before you hit delinquency, charge off, and then recovery strain. I think one other thing, Brooks, that I wanted to maybe make a note of here is how critically important it is to make early recovery decisions. So the longer you delay the recovery decision that you're going to make, the less benefit you will get against deficiency balance. So can you speak a little bit to that as well? And also, what are folks seeing and feeling in that refinance space where they may lose that loan altogether?
Yeah. So the one thing when you look at time to repo, right? And when I say time to repo, I mean when you're putting it out. So most institutions in the United States today are in that 60 to 90 day range, right? What we are seeing with our lenders that we work very closely with in this space is they're having higher reinstatement rates than they historically have, right? Which means that customer has gotten behind, they lose their car because it's been repossessed, and they're coming current with that because they don't have a way to replace that asset. So that is a trend that I've really been seeing over the last 4 to 5 months, really greater than what it's been in the past. I mean, we have lots of lenders that we've been doing business with a long time, and we're seeing historically high redemption rates for them. And some of them are looking at moving their repossession timing up to allow that vehicle, because it turns into a collection tool at that point. And we don't want repossession to be a collection tool, but that's in some cases what it's turning into. And what that's also leading to is just higher complexity with working with the borrower, right? Because it's not just I'm making a payment. Now it's I have to repossess the vehicle. The customer's then making a payment, and we have to arrange to get the vehicle back. So it's increased FTE in lending institutions with this, even though it's a collection tool. But it is causing some strain inside of lending organizations.
I think the other important point to all this is putting strain on those external partners. It's much more difficult for a repossession agent to navigate a redemption than it is a simple transport to auction. It's much more difficult for the options to navigate redemptions than it is to prepare that vehicle for sale. So through all this, the reinstatement process, the resource strain on picking up cars for voluntaries, and also just the transporting to a location and then having to transport back because of the increase in reinstatements, we're seeing an entire ecosystem of resources under strain as well. So it's not only lenders, it's not only borrowers, but it's those service providers who time is money for all of us as financial institutions or insurance companies or folks that service this industry. And there is pressure to get that vehicle, get it handled accurately, compliantly, with some level of borrower empathy. But at the same time, they're doing double work in many cases as we look at voluntaries and reinstatements. Do you want to talk a little bit about what that strain is doing on the industry?
Yeah, I do. And so it's not all doom and gloom, right?
No,
So
absolutely.
the good thing is that we are starting to see a leveling out of our capacity of vendors, right? We're starting to see some people add more trucks. We're starting to see people add some more staff. So we're starting to see signs of that the repossession volume is going to be higher for a longer period of time. And we have some people that are contemplating either expanding their footprint or even different people getting into the market that have been there before. So I know we've been talking in this industry for the last, since COVID, right? That the number of repossession agents has dropped drastically. I think we're at the bottom, and we're starting to see that maybe come back up. So that's some good news to be thinking about over the next 12 months, right? So when you talk about the complexity of our agents, right? It's not just the things that you talked about. It's not just the repossessions and the reinstatements and the things that, compliance things that states are adding that have to be done by the agent when they receive a car. You've got states out there that are requiring keys to be cut on site for every single vehicle, right? That causes complexity. You've got PII having to be removed at the repossession lot. So these are all things that haven't been contemplated in their business models, and they're having to go back and add to with FTE, which is lowering their margin. And we haven't seen an overall shift in the cost of a repossession over the last couple of years.
Absolutely. So let's move on to strategic partner evaluation. As you look forward to a different approach on this recovery ecosystem, not relying on these lagging indicators, some siloed practices and processes, as we look forward to attack this and optimize it, what do you think about shifting from vendor resources to strategic partners? What does that mean? And why is that going to be necessary moving forward?
Yeah, so you're seeing this across the industry in multiple different areas. You're seeing people moving away from a traditional direct vendor model into more of a forwarding model in a lot of cases, and multiple forwards. Because when we talked about it earlier, they're expanding their footprint in most cases, or there's so many more repos in their market, for them to have to be able to manage 8, 10, 12, 20. I've talked to a lender recently that they manage 300 direct agents, and they're like, it just takes too much time and too much energy. We've got all the technology built, but from a compliance perspective, to make sure that they're all in compliance, and you've got the management of them and all those different pieces, it's becoming somewhat overwhelming in the industry today, especially at these elevated delinquency and repossession volumes that haven't come down in the last 2 years as we expected them to, right? So as you think about that, thinking about lenders looking at how they can minimize their risk by going with fewer partners right? But having more oversight over those partners to try to get a tighter grip on compliance. And a lot of them are starting to lean into AI. The partners are, and so on how they assign vehicles and where they assign vehicles and when a vehicle needs to go out for assignment, all that AI is coming into play today. The one thing that I will be hesitant on is don't let AI just run your shop, right? Because AI will, it's great to help you make decisions. We use it every day at Allied, but we don't depend on it to let it run our models for us.
Absolutely. So when we think about this strategic partner evaluation, you're also thinking about the overall compliance and vendor management, which is significantly taken, a lot of resources inside financial institutions today. So that streamlining definitely does help with that compliance management. Let's speak now about just a partner in practice. So when you think about full life cycle, what do you think about in a partner or a strategy of partners that include or go beyond just that repossession activity?
Yeah. So, this is a nice little graph here to walk you through that, right? It's not just the repossession, right? I talked about it earlier when we were talking about things that you're looking at in your lending institution in the life of a loan, right? Are you tracking, right? And are you tracking using that information and that data that you get from insurance information to help locate cars? Are you using all the technology and skip tools that are out there to get that vehicle picked up faster, right? Once you get it picked up, right? Are you using the proper tools to make sure that you're getting that vehicle to the right auction, to the right third-party remarketing source, whatever those things are to liquidate the asset, right? If it's damaged, are you getting it to a damaged auction or are you getting it to a whole car auction, right? So these are things that as we move forward, technology is helping us to identify those earlier in the life cycle so we can make better decisions. When a vehicle gets to auction, if it has damage, are you filing claims on it from a lender perspective, right? And then we talked a little bit about the remarketing partnership. And then at the end of that, are you going back and looking, did it have ancillary products that need to be canceled that you can add back to the bottom line of your loan and bring that charge-off balance down? So these are all things that happen with inside of this piece that you should be looking at with your strategic partners. Can they help you manage bits and pieces of this or all of this?
Absolutely. I mean, when we think about the average physical damage recovery on an auto finance unit is about $4,200. And then you add that ancillary product refund on top of that, especially with where gap rates sit today, there's some real dollars there. And so, you're chipping away at that $7,000 to $8,000 deficiency balance if you can execute against those other recovery strategies, which then allow you less deficiency balance to have to try to collect from a borrower that you've already repossessed their collateral. So, and also looking at charge-off recovery, right? Yeah, it's been charged off and you may have had efforts to locate that, but what are you doing differently for your charge-off recovery and vehicles that need to be monitored post-charge-off? As we move on kind of past this strategic partnership, maybe talk a little bit about traditional models and then integrated models as we work to conclude today's webinar.
Yeah, so Ann, as you know, we've built something a little different at Allied, right? Which we consider an integrated model. And what it does is it takes all of our different product offerings that we have, whether it's a forced place insurance product that has skip on it, whether it's repossession, whether it's claims for total losses, ancillary refunds, and then, of course, our lender damage claims at repossession, right? We've built all those into one model so that it can flow all the way through, right? You don't have to have staff looking at just this piece or just that piece. Once it comes into our ecosystem, we can do all of those things for you with one transaction. That's different from a traditional model where you've got a total loss group that only manages total loss, and they are disconnected from the repo group, which is looking at damaged repos, and might not be filing the claims. So getting all this into one area and one workflow so that we are not missing those recovery opportunities in each step of that phase. We've seen great success with some of our partners and our lending partners that are doing this. And they've seen not only increased recoveries across the board, but they're also seeing a decrease in FTE and oversight.
Absolutely. So as we work to conclude here, we really appreciate the time and effort that Nick and Amanda Mueller on our team has put in to today's webinar. I think we could encapsulate this very simply, Brooks, by saying that embedded, augmented, and streamlined workflows and processes are going to be key as we move forward with the number of different tentacles that are in the marketplace, and always remembering that these partners represent your brand.
Outstanding information from Ann Holtzman and Brooke Stewart with Allied Solutions. Our webinar today, the next wave of auto risk. Is your recovery strategy ready? And just to wrap up our time together, Ann and Brooks, just a couple of quick follow-up questions. Ann, we'll go back to you, and then Brooks, your perspectives as well. Just again, to reiterate, just some of the most measurable changes in the past 12 to 18 months that you've observed and collected. Just again, just how did we get here? And let's go back to you, and then Brooks, your perspectives as well.
I think honestly, it's Nick, what we've seen is it goes beyond payment. And I think that's really coming to the forefront. What's happened in the insurance market, in the repair of vehicles, in the cost to own vehicles is creating a certain market situation that lenders have to deal with. And so as a result, the borrowers are much more fragile, and it isn't just the payment any longer. It's the affordability of the asset. And that we're beginning to see really come to fruition. I mean, at Allied, we track 22 million auto loans, highest number of forced place policies that we've had in the 17 years I've been with the organization. So people are having a difficult time with not just the payment, but the affordability of the insurance. So I would say that is really, I think, been the biggest change that we've seen. I don't know, Brooks, if you have something different to add to that.
No, I don't. I would just add on to that by saying with all of those things, an increased focus inside of lenders, we've seen that change that I haven't historically seen, where they're digging for more recovery dollars to kind of offset that. So that's something good, and that's what we're here to help them with.
Outstanding. Well, just to again also revisit what a topic you touched on toward the end of the presentation. Either of you would like to address, or one of you, just the largest differentiator that you see between an ARM solution and what else might be available in the market today? What do you see the keys to success there?
Yeah, I'll take that, Nick. Thanks. I think the biggest thing that we're seeing in our ARM solution today is looking at the number of vendors that we have under our umbrella and the things that we can not only do from a recovery perspective, from a lending perspective, helping those lenders that have the forced place coverages in place to where they have turnover in their organizations and they're not having to go back and retrain and miss opportunities in the recovery process by changing of strategies, changing of FTE in the organization. And it's really driving in those organizations that are using this product. Like I said, it is driving lower charge-off numbers because of the recovery dollars that we're adding back into the bottom line.
Closing moments on our webinar today. The next wave of auto risk. Is your recovery strategy ready? Featuring two of the wisdom-filled executives from Allied Solutions, Ann Holtzman and Brooks Stewart. Brooks, we'll go back to you, and then Ann to round us out. You mentioned it at the top of the presentation, the significant increase in insurance cost. Again, just how do you see that impacting repossession volumes? Where do you see the path going forward amongst the perhaps the two key metrics of our entire dialogue today? Brooks, we'll go back to you, and then Ann to round us out.
Yeah, and I'm going to leave the insurance side to Ann a little bit because that's her areas of expertise. And I'll talk a little bit about just the overall payment, right? And the overall payment of a borrower for their asset payment, as we talked about, is continuing to go up. Interest rates are, in the 5 to 6% rates on a new vehicle, and when you take that and you add it to the price of a new vehicle, and or a used vehicle, right? That payment's getting in the $900 to $1,000 range, and any life event that happens is putting them behind the eight ball and getting that payment made, which is leading to the delinquency and the repossession problem.
Yeah, I think when we look at insurance overall, without a heavy hurricane season this year, and we've had some other natural disasters for sure, I think you'll see some stabilization as long as repair costs can stabilize as well. And I think that's the big issue right now, is the cost to repair and the cost of downtime for vehicles. And so that is a huge pressure point for insurance carriers. As these vehicles become more complex, just like our cell phones have over the years, you see an increased stress in what is required to repair them and, of course, replace them. So I think one thing that we are going to continue to see will be an increased percentage of total loss vehicles as a part of collision accidents, which then puts pressure on GAP as well. So it's really important inside lenders that you have an optimized process for total loss and the filing of those accompanying indirect GAP claims, because there are strict requirements on timing. So that, to me, is an area of insurance and need that we're going to have to continue to focus on, including recovering on those total losses when you repossess a car and it could be deemed a total loss just based on the physical damage.
Taking us through the complexities of insurance, repossessions, recoveries, and more. That's Ann Holtzman and Brooks Stewart with Allied Solutions. Again, on the screen there is the technological path to reach out to either of them. A QR code is there displayed on the screen, and both Ann and Brooks welcome your direct inquiries and questions about topics of whether it's insurance, repossessions, negative equity. So many other elements are in play, and Ann, Brooks, and the entire team at Allied Solutions welcome the opportunity to work with you further. So again, thank you so much for joining us. Ann, Brooks, thank you again for so much wisdom shared. Both of you showing again that you're much more friendly than alligators or any other carnivorous critters that might be out there. Thank you again for the time.
Thank you, Nick. Have a great day.
Thanks, everyone.
All of us at Cherokee Media Group, we thank you so much for joining us, and we look forward to having you again next time.